Hello, welcome to Askimo TV. I'm here with Michael Friedman, the Executive Director of Asquith Merchant Bank, and we're talking about merchant banking and deals today. So Michael, perhaps you can tell us a little bit about how you'd identify an opportunity and what you would do next to negotiate a deal.
Sure. It's a fairly wide question, but in our particular case, we're investors in growth businesses. So what we're looking for is to identify entrepreneurs who have an essence of a good idea that they've already taken to the market, that they've already made some sales from. So we understand that they really understand and have something that's worthwhile. And we're looking for them to have a particular mentality where they want to grow their business over a number of years. And we're looking to invest in them to do so. Our first decision is do they have a product that we like, that we understand, and that we think other people are going to like and understand and wish to buy. And then our second is, do we believe that this is the right management team to execute a strategy of going into new markets and selling more of that product, and therefore giving us the returns that we'd like to see. And those are really our first criteria.
Okay, so when it comes to merchant banking, it seems like there's two sides of the negotiating table. There's the people who are investing capital into the merchant bank, handing it over to you to then go and invest in companies. And then, of course, there's the deal that you make with the companies themselves, the entrepreneurs, the startups, the growing businesses who are looking to expand and grow and turn a profit. How do you balance those decisions? Obviously, there's a lot to take into account. When you're negotiating a deal, what sort of elements are you looking at?
Well, the first thing is that we have quite a unique structure, which is beginning to become, I think, more prevalent in merchant banking and other parts of the asset management industry. So although we raise money from our investors and it sits in a fund, on a deal-by-deal basis, we still give some decision-making to our investors. So the first thing to say is that we don't act entirely alone in that process. Our investors have a seat at the table in those discussions, and if they really feel strongly that we as managers are doing something that's not really what they thought we were going to do, or they're just not comfortable, or maybe they just see a part of the transaction that we didn't really think about, they have the possibility to get involved in guiding us away from it or shaping the deal in a way that suits them. So the first thing is that I don't think there's any conflict between the two sides usually. There's a lot of collaboration, and really what we try to do is to bring to bear the experience of our investors. That's the first thing. And then what we start to look for are straight really into the minutiae of how a company is operating. So we do a standard type of due diligence. We look at their legal documentation. We look at how and when the company was formed. We look at whether they have any legal disputes. We try to understand whether their intellectual property is correctly registered. What is their intellectual property? We start to look at commercial aspects of their business. How much cash do they have on the balance sheet? How many contracts have they signed up to? Do they have the cash to fulfill that order book? How quickly will they then start to generate returns? And also, have they signed up to any other forms of finance that we think are going to end up putting them under pressure? Or have they found another form of finance that actually we should encourage them more to take? So, for example, as an equity investor, we're often looking for what's called leverage, which is essentially that we put in some money and then we find a bank, for example, that's prepared to lend alongside us. And what that means is that we usually get a slightly better return on our money because the bank's money is at a cheaper price than the company is able to pay back. And we get to share some of those differences, and that's basically what leverage is. So we're looking at a very holistic level at each transaction that we do and trying to understand as many aspects of the company as possible. And then what we're able to do is to get fairly strategic about how we invest. That comes down to, again, this is a big difference, I think, between us and other forms of investor companies, is that we're looking at who can we bring in to come in and invest alongside us, and can they be strategic? So we'd be looking to find banks in countries or investors in countries where we think the company has a chance to roll out, because we think that those investors are able to provide some boots on the ground. So we're even able to use the fact that we invest in a particular way to aid the company in the process of growing.
Now, when you go into the negotiation process, there's a range of people sitting around a table who are all trying to get the best results for themselves. Everyone's got their own interests. And can you maybe give a little bit of insight into how you would ensure that you're getting the best deal for yourself, that your interests are protected, and that you're walking away with your notion of what a successful deal is?
Yeah. Well, I think that really you've already summed up what our answer is, which is that we have to walk away feeling like it's successful. And that's very hard to always put a finger on what exactly that means. There are certain benchmarks that we're looking for. We have an idea of what our return should look like. We're also looking to make sure that we've covered off as much of our risk as we can. But the objective is very specifically in our line of work to make sure that the people on the other side of the table feel like they got a good deal as well. Because if they don't feel they got a good deal, then we will end up in an adversarial position with them in a few years' time. So we may get to a point where they say, well, we don't like those guys. We cut a deal that actually was too rich. We can be better than that. We want to find a way to push them out of the deal or renege on what we did. And at the same time, we're also trying to make sure that they have given us a big enough piece of the pie that we and our investors are happy, so that they've kept a big enough piece of the pie that they actively want to grow the business. And they don't just say, you know what, someone's offered us some money, let's just take it and leave. We want them to feel like they have every incentive to grow the business in the right way. So part of what we do is always to try and understand the other side of the table as well. And our merchant banking structure is very different to an ordinary private equity or venture capital investor structure in that we wear three different hats. One is that we're investors in the businesses that we are helping. The second is that we are advising those businesses as well. So we're taking them to see other investors alongside us. So if we negotiate a deal that's good for us, and then it turns out not to be a good deal for any of the other investors, that causes problems. Equally, if we negotiate a deal that's good for managers but not good for us, other investors won't come in. So we're immediately benchmarking whether we found the right way to structure the deal by taking this company with us into the market to meet other investors. And that's quite unusual as a structure, but it does keep us honest and it keeps the entrepreneurs honest. And then the third thing that we're doing, as I said, is that we're often looking for strategic investors, and we ourselves are probably considered to be fairly strategic, in that we have a team of consultants that work with us, so that every deal that we take on, we're actively going out and helping them to grow. And again, I think that what we've learned is that the most important thing when you're making any negotiation is not necessarily to have control. So on a very simplistic level, and you see this when you watch TV programs like Dragon's Den, people have a sort of obsession with the idea that they have to keep 51% of their company. And actually the numbers are fairly irrelevant, because you can include any number of really fancy and complex legal structures that allow you to take control or give control away if various events happen. And actually we think the most important thing is to understand how we influence a transaction, how we influence a company. Influence is generally very positive. If we're behaving in the right way and we show that we know a given amount about a given area, most investees will want us to be there and they want us to sit on the board, and we don't even have to ask. They just say, you guys are strategic, you're helpful, you help to defend us, we want you there. And that changes your whole relationship. And I think that you have to sit down at the negotiating table with that spirit in mind and expect that you're going to get up with the same spirit in mind.
Okay, thank you very much for your time today.